expert opinion. As a part of our special series, Asian Tigers, Udayan Mukherjee caught up with Amit Bhartia, the portfolio manager and partner at GMO, and began by asking him about the rally we've seen across the Asian markets and whether it feels real to him. Thanks so much for watching Bazaar.
Emerging markets have underperformed developed markets for the past 5.5, 6 years. It's only in the last 6 or 7 months that emerging markets have done quite well. And we think the rally is real, and that comes from a few drivers. One, the vulnerability in the asset class has come down significantly over the past few years as currencies have adjusted, oil prices have fallen. So the risks in the asset class are significantly lower than they were a few years back. And on top of it, you have an asset class that has so massively underperformed developed markets. I think we are seeing increasingly appetite from asset allocators to reallocate some money in emerging markets.
Is that really happening? Because I speak to some long-only fund managers or country-specific funds, and they seem to be puzzled that India's got $5–6 billion in a month or a few weeks, but they've not got any money. They say maybe ETFs are getting money, maybe people are chasing momentum, but we are not getting too much money. That is inconsistent with your experience?
Well, if you look at the fund flow data, which it's pretty clear that emerging markets continue to record good amount of inflows. So obviously some amount of money does flow through India, whether from a domestic perspective or from a global perspective. But I think what matters in India much more is domestic liquidity, and that's always been an attraction towards India, and maybe that's finally happening as some of the savings that are redeployed back in equity markets rather than fixed deposits.
But do you get the feeling that asset allocators are finally feeling that after 3–4 years, maybe EM is the place to be, cyclically speaking, or are they still skeptical?
I think there's a fair amount of skepticism still there, but on our indicators, a lot of indicators have turned positive for emerging markets. An indicator actually, which is actually a very good contrarian indicator, is actually turned negative, which is allocation towards emerging markets. So last year, while everybody was consensus underweight in emerging markets, now it's not as negative. So people are actually neutral on emerging markets. So
but not bullish, not overly.
Not overly bullish. So you can argue both ways. Look, there's a huge amount of opportunity still there, but you can also argue that a lot of money has already come into the asset class.
How does India stack up? Because sitting in India, you get the feeling we are having a terrific run, but everybody's having a terrific run. How does it stack up for you? India compared to the other markets that you look at?
Well, I would answer this question from two perspectives. One is from a shorter perspective and from a longer term perspective. So from a shorter term perspective, I would argue that is a 12 to 18 month period. India is at the middle of the pack. The positives going on for India is a very strong domestic liquidity, as I just talked about. Money moving from domestic savings to equity markets. That's positives. On the negative side, corporate earnings are actually quite poor in India. So I would say it's a lot of it is also a hope-based rally going forward. And let's not forget, in 2 years we'll again be talking about political outcomes, social issues, and so on. So these are pluses and minuses from a shorter term perspective. From a longer term perspective, I worry, as Bon Jovi likes to say, we are always kind of living on a prayer kind of mode. So India, unlike China, is not really de-risks its growth model. So we are always dependent either on oil, monsoons, technology, environmental issues, which can derail domestic growth and creates huge kind of problems. So that's on the negative side. But on the positive sides, obviously, as oil has come down, if you look at it, oil is down about 70% from the peak in Indian rupee terms. So that's a huge positive for India. I like some of the initiatives what the governments have done, which can de-risk India in some sense, whether it's creating new domestic drivers. So I like that.
You spoke about earnings. 2.5 years, there's been practically no earnings growth. Are you confident that we're going to start to see the needle change, or as you said, it's still in the realm of hope? The biggest problem which is impacting earnings is, private sector. So the private sector is, very reluctant to spend, and obviously a part of it is, capacity utilization still is quite low compared to existing capacities. A lot of balance sheet issues are there in private sector, and there is no
kind of growth in the economy. So it's kind of creating this vicious circle in which the private sector is reluctant to spend. So you've got consumer as a driver who's been fairly aspirational and much more resilient, and you have the government sector which is spending. But the corporate sector capex is completely missing, which will impact earnings, in my opinion, for the next few years.
It's interesting that you say that there is not too much growth. If you speak to the government, they say, what are you talking about? We are growing at 7% plus. We are the fastest growing economy. So where is this lack of growth? But is it consistent with some of the other data that you look at, which indicates how fast we are growing?
Not really. So, I mean, we track a number of other indicators, and if you look at cement data, port data, auto sales, and if you correlate that with historical growth series, I mean, it's pretty clear to us that GDP on a like-to-like basis is not growing maybe 4 to 4.5%. So yeah, growth's quite muted in India, that's for certain. And another problem I have is when politicians talk about growth rates is looking at a very myopic picture, in my opinion, because what matters is the absolute level of growth, in dollar terms or in real terms. So let's take some numbers, right? So India's per capita income is about $1,700 a year, basically. So even if you grow at 7%, what the government claims it to be, per capita income is growing only at $115 a year, compared to, let's say, China, where per capita incomes are growing at $500 a year, or even in Philippines, where per capita incomes are growing at more than $200 a year. So a Philippine consumer is growing twice that of India in dollar terms. A Chinese consumer is growing 5 times more than India in per capita dollar terms, and that's what matters.